Hi everybody, my name is Griffin Bridgers. Welcome to this part 3 of the basics of the generation skipping transfer tax. Today we're going to talk about a specific form of transfer known as a direct skip. Now before I get started, I want to remind you that this presentation is not intended to substitute for legal or tax advice and is provided for educational purposes only. So this is a continuation of a series on the basics of generation skipping transfer tax, designed to educate attorneys, wealth advisors, CPAs, trust professionals, and other aligned professionals who deal with intergenerational transfers of wealth. Now, I do my best in this series to bring things down to a basic level, but a lot of what we talk about for streamlining purposes will assume that you know the basics of the estate and gift taxes and how they're calculated and some of their exclusions and deductions. So, to get maximum value out of this video in particular, or the series in general, I suggest first that you be familiar with gift and estate taxes. If you're not, you can still try to follow along, but you may get lost at some points, and I can't fill in those gaps. So, in parts 1 and 2 so far, we've learned that we have a GST tax imposed on what's defined as a generation skipping transfer. We haven't defined that yet because in part 2 we looked at the parties we must first have to even be able to define a transfer as a generation skipping transfer. We have to have a transferor on one side making the transfer and a recipient who's defined as a skip person for purposes of the GST tax. A skip person is an individual who, if they're a descendant of the transferor's grandparents, is somebody who's 2 or more generations younger than the transferor, generally with a living parent. And if you have a recipient who's not a descendant of the transferor's grandparent, then they can be a skip person if they're an individual other than a spouse who's more than 37 and a half years younger than the transferor. So with that backdrop, here's our illustration again of how everything works and why we have a generation skipping transfer tax. Because you see, by skipping generation 2 with this transfer of $100 million, you save a estate tax of $21,105,600 that would otherwise apply on the transfer from generation 2 to generation 3. But that missing layer of estate tax gets replaced by a generation skipping transfer tax in that same amount. Now, with that being said, now we finally get to the point where we define a generation skipping transfer. And the categories of generation skipping transfer are either a taxable distribution, a taxable termination, or a direct skip. Today we're going to focus solely on the direct skip, and it's perhaps the easiest one, but it will set the stage for the taxable distribution and the taxable termination. As we're going to see, the big difference between the direct skip and the other two is going to be timing. When does the tax apply? So direct skips are pretty self-explanatory. It's just going to be a direct transfer to or for the sole benefit of one or more skip persons. So not all-inclusive, but here are some examples of direct skips you could have. You could have a direct cash gift or a direct gift of property to a skip person. That would be a direct skip. You could have maybe a crummy withdrawal right in a trust granted to a skip person. That would be a direct skip. You could have a situation where maybe you fund a 529 plan or a custodial account for a skip person. That would be a direct skip. And you could also have a transfer to a trust for which the only beneficiaries are skip persons, and that would also be a direct skip. But I bring up a trust to illustrate that most of the time, when you have a transfer to a trust, you're not going to have a direct skip. The difference is going to be timing, and that's what distinguishes the direct skip from other categories of generation skipping transfers, namely taxable terminations or taxable distributions. The big difference is when a direct skip is made, you know exactly how much is going to a skip person. So to have any tax apply to begin with, you have to have a determinable amount of the transfer. So with the direct skip, you know exactly how much is going to the skip person. So when that transfer is complete, you know exactly what the GST tax liability is going to be. So with a direct skip, the GST tax liability always attaches immediately. We're going to contrast that with a situation where there's a trust that has skip persons and non-skip persons as beneficiaries. In that type of case, when that trust is funded, you might have an estate or gift tax, but you have no way of knowing how much a skip person might receive unless and until there's maybe a distribution of a set amount to that skip person, or maybe the trust terminates and there's terminating distributions, which creates a hint for the next two forms of generation skipping transfers that we're going to look at in later installments, because we're just discussing the direct skip today. So to wrap our heads around this a little bit more in this timing issue, it's helpful to look at the context that all generation skipping transfers can be made either during the transferor's life or at the transferor's death. And in this case, with the direct skip, because we know exactly how much is going to a skip person, these are the results. For one, if you have a transfer during the transferor's life, then the direct skip could be subject to both gift tax and to the GST tax. And similarly, if you have a direct skip transfer at a transferor's death, it could be subject to both the estate tax and the GST tax. Now, if you're familiar with the gift and estate taxes, you know that they rarely apply, but really the reporting and use of credit and exemption applies in tandem for the direct skip type of transfer. And that means that two things could happen when there's a direct skip. You could have GST exemption applied and applicable credit applied to offset gift tax or estate tax as well. And as we'll later see, transfers that are not direct skips really defer any GST tax liability until some later point, which is, you guessed it, a taxable termination or a taxable distribution. So the direct skip is the only form of transfer that does not defer the GST tax calculation or liability. In any case, anytime there's a transfer, you're going to have use of GST exemption and use of applicable credit typically before any tax liability attaches, but only with the direct skip would you have any actual GST tax liability if the exemption is used up. So to close the loop, here's an important point. It helps to recognize the difference between the gift and the estate tax. The gift tax is tax exclusive, which means that the gift is not reduced by the gift tax. It means the transferor makes the gift and, in addition to the gift, pays gift tax. However, contrast that with the estate tax, which is tax inclusive, which means that inheritances are reduced by the estate tax. Now, for direct skips, the GST tax is going to follow those same types of rules. If it's a lifetime transfer, it'll be tax exclusive for the GST tax. If it's a transfer at death, any GST tax liability will be tax inclusive. But because the GST tax for lifetime transfers is tax exclusive, there's an ordering rule. Since you could have both gift and GST tax applying, which do you pay first? Do they affect each other? And the answer is yes. You can find that answer under Code Section 2515, which says that the amount of any direct skip, which is a taxable gift, will be increased by any GST tax paid before you apply the gift tax. So what that means is that on a direct skip, whatever the amount of gift you're calculating and reporting for purposes of a gift tax return or even to determine the use of the annual exclusion has to first be increased by the amount of the GST tax that was actually paid out of pocket on the transfer. So in other words, you pay gift tax not only on the value of the gift, but also on the value of the GST tax that was paid as well. And that's the catch-22 of a tax-inclusive double tax applied to the same transfer. So next installments will explore taxable distributions and taxable terminations, but for the time being, if you have questions or topic suggestions, you can email those to me at griffin.bridgers@gmail.com with the caveat that I cannot give tax or legal advice in response to your questions. But I thank you for joining me for this part 3 of the basics of GST tax. I look forward to seeing you in future installments of this series and seeing you in my future content.